In today's video, what we're going to be talking to you about is the iShares Core S&P 500 Index ETF. It trades as the ticker XSP. And of course, is this a good ETF? Let's get down, let's check this out. So when it comes to index ETFs, the first thing I really want to look at is, of course, the MER, the expense ratio, and this one is 0.09%. And what does that give us? Well, that gives us the ability, obviously, to invest every single year. They're going to be taking 0.09%, which means that for every $100 that we put into this ETF, they are going to be taking 9 cents as their commission, essentially. So, is this good? Well, it's kind of interesting, right? So, first off, it is Canadian hedged, which means that it's hedged to the Canadian dollar, which is going to actually help out when it comes to investments and really trying to see the future of it. So why is that important? Well, hedged ETFs basically mean that they keep just a bit more cash on hand because then they can not have the fluctuations of currency. So as an example, if this went up 10% and then we would see the currency also go down by 10%, well, guess what? This would make that even and we wouldn't see an increase or a decrease. However, when we start having it being hedged against the dollar, they do some different currency games so that we still have a small profit and should be a continuous profit throughout, and we should not be affected as much to the fluctuations in the currency. And the why I'm really mentioning that with the MERs, because when you start looking at things like SPY, which is essentially the same thing, or VOO, which is the Vanguard equivalent to SPY, and these are essentially equivalents to this, is because if you were to invest in SPY, which is kind of the going thing to invest in if you wanted to basically invest in the market as a whole, or VOO, when you start investing in those are in American dollars. And if you were to invest in those, in let's say a TFSA or an RSP or a margin account or whatever, and you're Canadian, if you have it on your Canadian portion, which means that you paid Canadian money to buy it, then it's going to be basically fluctuating with currency. And then there's also the option of buying it inside of an American money account where you can then basically buy American money and then buy SPY or VOO or whatever. Then you're still playing the currency game because you could buy in at a certain rate, and now when you sell that ETF and it sells back into Canadian dollars, or you bring it back into Canadian dollars, now you've got that whole Canada-US money fluctuation currency game where some people just don't want to deal with that. And personally, I don't like dealing with that garbage either. It's kind of a pain to really think back and say, well, 5-10 years ago, what did I buy it at? I don't know. What is it? And it just gets to you. It makes your brain hurt sometimes. So with hedged ETFs, sometimes that's just a better choice. And of course, the yield is not bad considering that it is a full index market fund. And of course, 1.23% is not terrible. It does have a higher volume than most as well. So when you're looking at something like the XSP, this might actually be a pretty good ETF to invest in. Now, when you look at a 5-year chart, we can see that just like the market itself, it tends to go in runs. And this current run is quite high if you really look back. We can see that each run is, of course, not terrible. We see a couple of runs here, we see a couple of runs here, and now we see a massive run here, a little bit of a pullback, and then another run here. So almost like a gear ratio in a car, you start seeing how there's just maybe not sustainable for a bit, but of course, you could invest now a little bit, invest a little bit more later. It's totally up to you. And then you really want to look at the dividend, and unlike SPY and VOO, which do pay quarterly, this one does pay every 6 months. Generally every June and December it will pay a dividend, which depending on your style or what you're trying to do, if you're trying to live off of dividends, which 1% is not a ton, you would be generally doing this throughout your lifetime so that when you become in a retired state, you will still have a good dividend from all of the past. And then you can draw upon it, because a 1% dividend today, if you're buying in at 1% dividend, you're generally looking, let's say 30 years down the road. Your initial dividend, because they increase the dividend, could be looking at like generally a 4, 5, 10, whatever percent dividend in the future. If you want to try and figure out the math, there's lots of different videos online that do teach you that. So this is why I like dividends, and this is a great way to invest if you're looking over 10, 20, 30, 40 years. This would not be a dividend strategy if you're trying to live off of dividends today. And of course, just like the market itself, its top 10 holdings are literally the top 10 companies on the stock market on the S&P. That's Apple, Microsoft, Amazon, Facebook, Alphabet. I've always laughed at how they have 2 listings for Alphabet, but anyways. Tesla, Berkshire Hathaway, JP Morgan, Johnson & Johnson. If you can invest in these specifically yourself without going through an ETF, you may make more money. However, you will have more risk. I hope that you've enjoyed today's video. If you have, hit that like button, subscribe, go check out my favorite investing books down in the description below, and I'll see you guys again next time.